Alison, I remember us standing by our Otis Bilodeau by the Bloomberg terminal as the first day of those first stress tests came out. That seemed like a really real, immediate, real-world experiment. Does today have even a shadow of that intensity?
I think it does, and I think that, if you want to think about it long-term, the fact that these tests were put into place provide us with this framework to see today, what the regulators think in terms of the bank's ability to withstand this severe stress, given this really unusual and unprecedented downturn.
Are there profitability at threat? Is there profitability a threat?
Their profitability is a threat, and I think the main factor that everyone will be focusing on, the factor that we've been focusing on, is the provision for credit losses. One thing that we've seen in this real-time experiment is that the capital market side of things have held up better. So trading revenue has been really strong at some of the larger banks, including for 2Q. We know that that's going to help to offset the provisions. However, obviously that had a lot of help from the Fed and fiscal response help that has gone into the market. For the stress test today, what we will learn is, how their capital will fare with a set of scenarios that were sort of designed before the pandemic took hold. And that's sort of the really detailed results that we'll get, the results we get every year, how the banks fared in this hypothetical scenario that tests both the earnings side and sees how the capital holds up. The more interesting test is sort of the added layer that was put on. It's different than the prior test in that there's three different scenarios. As you were all discussing, it's really the shape of the recovery, the depth and length of the recession that's going to decide how bad the provisions are, and that is what regulators are going to be testing. Unfortunately, we're not going to get the same level of detail there. We'll get an aggregate summary, we think. That's what Quarles alluded to on Friday. But what that will do, I think, is sort of frame the question of what will regulators do with regard to dividends, and that's been another key question for investors.
So the question that a lot of people have is, how much is it already baked into markets that banks are going to cut dividends further from here? I'm looking right now at the KBW Bank Index, down 33% year to date. So some of this has already been priced in, correct?
Well, that is the question that we get a lot, but what we thought was interesting, and in fact, we just ran this chart last week when we were doing our preview. If you look at the declines across the bank, with Wells Fargo being the most significant, the declines are actually not too dissimilar to the cuts to EPS to 2021 EPS estimates. In fact, they line up pretty well. And so someone like Wells Fargo, where there's a lot of worry, not because of the capital side, but because of the earnings side of things, they've also seen a much more dramatic cut in their earnings estimates. So it's difficult to say. And I guess the other thing I would add is we've had a couple of asset managers that have cut their dividends. You see sort of the dividend yield spike right ahead of this. That's signaling that there is some risk to the dividend, but the stocks still got hit hard. Keep in mind that there's a lot of investors out there that own stocks just for the dividend, and so there could be some implications there. But to be clear, I don't think we're going to get those types of announcements today.